Paying zero tax on a retirement income of £57,000 sounds too good to be true, but it's not. I'm going to show you an example of a couple that one of my colleagues has been working with and how we got them into a position where they could sustainably draw almost £57,000 of retirement income without paying any tax. Now, don't worry, I'm not going to waste your time with an example that relies heavily on ISAs or taking tax-free cash from a pension. What I'm about to show you is an unusual example. I do not expect many people to have a situation exactly like this. But the reason why I think this example will be really useful for you, no matter who you are, is that to achieve this level of income, we're going to have to use pretty much every financial planning tool and tax allowance that there is. And because we're going to build this up slowly, you'll see how we first go about creating £15,000 of tax efficient income, then 30, then 40, and so on. So by the end of this, you should walk away with a very good understanding of the strategies that you should be using to create a tax efficient income in retirement. Hello and welcome back to the channel. If you're new here, hi, my name is James. I'm a financial planner, and this is a place where you can learn to make smarter financial decisions. When we met Henry and Anna back in 2021, Henry was 61 and Anna was 63. Henry was still working, but was keen to retire in the near future. The main reason that he hadn't done so already is that he didn't think that he could afford to. Henry and Anna have grown-up children that are living abroad, and they were already spending a lot of money traveling to see them each year. So Henry did not want to retire until he was confident they could afford to keep doing that and to spend even more time abroad. To sustain this quality of life in retirement, they thought they would need to spend about £55,000 per year. Up until this point, Henry and Anna had always assumed that property would be their pension, and over the years, they'd built up a small portfolio of buy-to-let properties. But the problem was that due to changes to tax legislation and a series of poor tenants and costly bills, they could see that their portfolio was never going to be able to provide them with the retirement income that they were looking for. When we met them, they had £30,000 of cash and were in the process of selling their properties, which would eventually net them £550,000. Henry had also been paying the default into his workplace defined contribution pension, so had £120,000 in that, and Anna had £25,000 in hers from an old job. So this was their starting position, and it's clearly quite an unusual one. Although this does happen more often than you think. People in their 60s are often downsizing or receiving inheritances, or in their case, selling other assets, which then leaves them with a lot of cash that they need to invest. But again, the reason why this example is interesting is not because the figures are relatable. It's interesting because of the steps that we're going to need to take to maximize their income. So let's start by looking at how we initially invested their money. For most people, by this stage in your life, your pension should be your largest asset. In the UK, it's the most tax-efficient tool that we have for building wealth. So clearly, Henry and Anna have a lot of catching up to do. But first, we had to clean up what they already had. So we opened SIPs for them, transferred in their old workplace schemes, and invested them into a globally diversified portfolio of 60% stocks and 40% bonds. The focus of this video is tax efficiency rather than investments. But just so you know, all of the investment accounts that we're going to look at were invested into similar things. Back in 2021, the annual pension allowance was £40,000. However, because Henry was earning £60,000 per year, and in prior years had only been putting the default into his workplace pension, we were able to carry forwards unused pension allowances to bring his maximum annual pension contribution up to £60,000. Anna was not working, but even if you earn nothing, you can still make a pension contribution of up to £2,880, on which you'll get basic rate tax relief added on top. Next, given that Anna had not been working for some time, she had some gaps in her national insurance record, meaning that she was not going to get a full state pension. To get a full state pension, you need 35 qualifying years of national insurance contributions. I've done a video on this in the past, which I'll leave a link to down in the description. But if you do have gaps in your NI record and you're not likely to get them through future work, making voluntary contributions to top up your NI record is likely to be one of the best investments you'll ever make. So we spent £5,000 topping up Anna's NI record. Then we put £20,000 into stocks and shares ISAs for each of them. Now, most people don't get anywhere near to maxing out both their ISA and pension allowances. But if you're saving a lot of money, have a reduced pension allowance, or you end up in Henry and Anna's situation with a lot of cash that you need to invest at once, then you're going to need to find another home for your investments. Typically, the next step is to use a general investment account. a taxable investment account where you may have to pay taxes on any capital gains and dividends. Back in 2021, you could receive up to £2,000 of dividends and realise up to £12,000 of capital gains in a single year without paying tax, which meant that you could potentially manage about £100,000 in a GIA without having to pay much tax at all. But even if we split this money between them, having over £200,000 in a GIA is likely to cause big tax headwinds. So instead, we decided to put £200,000 into another type of tax-efficient investment account, which I'm going to talk about in more detail later on. So this is where we initially invested their money. But over the following years, we continued to max out their pension and ISA allowances by taking money from their GIAs, so that now, in 2024, their assets look like this. Obviously, they don't look exactly like this. I'm going to use round numbers here to make the next part easier to visualize. Now, we're at a point where they want to retire. So the next challenge is, how are we going to hit our target of £57,000 of tax-free income? To do this, we're going to need to make use of every tax allowance that they have available. So let's start with pensions. When you get to retirement age and you want to start drawing money from your pension, there are two distinct parts that you need to be aware of. There's the tax-free part, also known as tax-free cash, which is typically 25% of the value, and then the other 75%, which you pay marginal rates of income tax on when you draw it down. You can choose to take your tax-free cash as one lump sum, or you can choose to take it bit by bit throughout retirement. So if Henry wanted, he could take a lump sum of £86,000 from his pension completely tax-free, which sounds great, but taking all of your tax-free cash at the start of retirement is often a big mistake. Firstly, if he does this, sure, he's not going to pay any tax initially, but because he's depleting this tax-free reserve, it's likely that as a knock-on effect, he's going to end up paying a lot more tax in the future. Secondly, if Henry keeps the tax-free part of his pension intact, it has a chance to keep growing, meaning that he could draw down even more tax-free cash in the future. So for Henry, the correct first step is to draw £12,570 from the taxable part of his pension, which would be tax-free because it falls within his personal allowance. To do this, he's going to need to crystallize part of his pension, which means he's also going to need to take the proportional 25% of tax-free cash. So in total, Henry will be drawing £16,760 from his pension, and all of this would be tax-free. For Anna, however, given that she's 66, she's already in receipt of her state pension that comes in at £11,502 per year. So to make use of her remaining personal allowance, we could draw an extra £1,424 from her private pension, bringing us to a total of £29,686 in tax-free income, just over halfway. And we're also halfway through the video, so it's time to hear from our sponsor, which is me. This is actually a job ad. I'm looking to hire a video editor. Now, I know you're probably quite surprised to learn that I don't already have one, given the high quality of videos that I put out. And I'm sure you're wondering how they could possibly get any better. Well, unfortunately, I think they probably can. So if you're an editor that's good with infographics and you want to learn a lot about investing, I would love to hear from you. So there's a link down in the description where you can find out more. The next thing we need to consider is the interest that they are earning on their cash. At a 5% interest rate, they are each receiving £1,250 of interest per year. And there are two tax allowances that can help here. The first is the personal savings allowance. As no or basic rate taxpayers, Henry and Anna can earn up to £1,000 of savings income each year without paying any tax. But what about the other £250? Well, there is another lesser known tax allowance called the starting rate for savings band, which in certain situations enables you to earn up to an additional £5,000 of savings income without paying tax. To understand how this allowance works, you first need to understand that in the UK, there are 3 different categories for income that are taxed in a specific order. We have dividend income, which is self-explanatory, savings income, which includes bank interest, bond coupons, and income from other savings vehicles, then non-savings income, which includes income from employment, pensions, rental income, and most other types of incomes that do not fall into the other 2 categories, with non-savings income being taxed first, then savings income, and then finally dividends, which we need to know because dividends are taxed at lower rates than other income. But this also affects this starting rate for savings allowance. In our example, Harry has £12,570 of pension income, which is non-savings income. So the way the starting rate band works is that if the next £5,000 of income that he receives is savings income, it will be tax-free. But if, say, Harry also had £3,000 of rental income coming in, which is non-savings income, not only would that be taxable because it's over his personal allowance, but it would also eat into his savings rate band. Whereas if he had £3,000 of dividend income coming in, this would be taxed after his savings income, leaving his savings rate band intact. Understanding how this allowance works is very important for business owners, retirees, and those that earn less than £17,570 per year. So if you do have any questions on this, please do let me know down in the comments. For Harry and Anna, this allowance means that all of their savings income is tax-free, which brings us up to £32,186 of tax-free income. Next, we have two options. We can either take money from their ISAs or their general investment accounts. Again, we want to try and preserve tax-free growth environments for as long as possible, so we don't want to touch the ISAs. General investment accounts are taxable accounts, so any income they receive or gains that they realize may be taxable. At current yields, we might expect the stocks in their portfolio to pay dividends of about 2% per year and the bonds to yield about 5%, which means that they would each receive £600 of dividends and £1,000 of bond coupons. And now, given that bond income is counted as savings income, this would fall within their starting rate for savings band and be tax-free. But for their dividends, we might have a bit of a problem because before 2018, everyone had a dividend tax allowance that meant that they could receive up to £5,000 of dividends per year tax-free. But unfortunately, over the last few years, this allowance has been decimated down to just £500, which means that £100 of their dividends will be taxable at 8.75%. Unfortunately, there is no way to get around this, but even though this is a tiny amount of tax, it's technically not tax-free. So let's exclude this income from our totals. So we're now up to 35k of tax-free income. The next allowance we're going to use is their capital gains tax allowance. Again, the government has reduced this allowance significantly over the last few years, so that now only the first £3,000 of capital gains that you realize each year will be tax-free. The cost basis for their remaining GIAs is £45,000. So if they sold down the whole thing, they would realize £5,000 worth of gains. But if they sold down £30,000, this would realize £3,000 of capital gains and therefore would be tax-free. So that's what we're going to do. But instead of taking all of this as income, we're going to reinvest £20,000 of that into each of their ISAs, and then, just as we did before with Anna, invest £2,880 back into each of their pensions. There are pension recycling rules that normally prevent people from taking money out of their pension and then putting it straight back in to get more tax relief. But this small amount is actually allowed, which would then leave them with £7,120 that can go towards their income. Now you might be thinking, James, that's not really income. You're just cheating and selling down their assets. Now, technically, you're right. It's not income in the traditional sense. But when it comes to retirement planning, income is largely irrelevant. If you're looking to spend, say, £50,000 per year, you should not care whether that cash comes from income or selling down assets and realizing capital gains, especially if to be tax efficient, you're going to need to draw down different amounts from different tax buckets. All you should really care about is whether it's sustainable. So far, including these withdrawals, we're only drawing just over 4% from the value of their overall portfolio. And in 2 years' time, when Henry's state pension kicks in, that will drop to less than 3%. So given this and their ages, it's highly likely that this is going to be sustainable. The final step relates to this account here, which is called an offshore bond. Now, despite its name, this is not actually an investment in and of itself. Although technically an insurance product, it's essentially just another wrapper that investments sit within, just like a pension or an ISA. And just like those accounts, it comes with some unique tax features that make it useful in certain scenarios. If you remember, we decided to invest £100,000 for each of them into an offshore bond because the alternative was holding that money in a general investment account where they would likely have ended up paying a lot of income tax and capital gains. Now, one of the key features of an offshore bond is that money invested within the bond grows free of income and capital gains tax. However, when you come to cash in the bond, any growth in the bond's value is taxable as savings income. In the UK, we pay much higher rates of tax on savings income than we do on either dividends or capital gains. So this might sound like a disadvantage, but an offshore bond gives you much more control over when you trigger that tax so that you can do it at a time that is advantageous. The other key feature that enables this flexibility is that of the money that you put into the bond, so in Henry and Anna's case, £100,000 each, they have an annual allowance whereby they can draw 5% of that back out without triggering any tax. And this is a cumulative allowance. So if you don't use it one year, you could draw 10% the next year. And in Henry and Anna's case, because they've held it for 3 years, they could each draw down £15,000 without triggering any tax liability. Then in theory, they could keep drawing 5% from the bond each year until they have completely withdrawn their principal without paying any tax. However, the reason this works so well in Henry and Anna's situation is that between their starting rate for savings band and their personal savings allowance, they could receive an extra £3,750 of savings income this year without paying any tax. So for the sake of this example, let's say they crystallized enough gains from the bond to make use of their remaining savings allowances and not pay any tax. Now, this is a very simplified explanation of how an offshore bond works. In reality, they are one of the most complex tools in the financial planning toolset. And fortunately, very few people will ever need to use them because they are only really useful if you have already maxed out your pensions, ISAs, and already have a large GIA. Now, in reality, this year, we actually decided not to take anything from these offshore bonds because Henry and Anna had decided to get a lodger. Given that their kids had now left home and they're rattling around in quite a big house, and they're going to be spending quite a lot of time abroad, they thought it would be a good idea to find someone who could help take care of the dog and the house whilst they're away and bring in some extra income. Income which would have eaten into their starting rate for savings band. But the handy thing is that there's actually another allowance called the rent-a-room allowance that means that they can receive up to £7,500 per year from renting out their home, and it's completely tax-free. So either way, they've got almost £57,000 of cash flow coming in entirely tax-free. And it's all because we've spent the time over the years getting their money into these different tax buckets so that they have the flexibility to draw an income and make use of all these allowances. And the other important thing is that this is likely to be sustainable, not only because it's an acceptable overall withdrawal rate, but because we're preserving their most tax efficient wrappers, which means that they're likely to be able to draw a very tax efficient income well into the future. But there are two things that I need to make clear. The first is that this was the optimum solution for Henry and Anna's specific needs. They were looking to try and maximize their retirement income. But if instead they had been concerned about inheritance tax, we might have gone about this differently. And secondly, the only reason we're having to use this complicated multi-bucket tax planning strategy is because we did not have the time to get all of their money into pensions and ISAs, which would have been much easier, more flexible, and tax efficient.